Okay, welcome back, economists. We are here to think about our second diagram in the macroeconomics unit. In previous videos, we have covered the circular flow of income model, and there's a pretty strong connection between that model and this one. Obviously, this one's going to be about the business cycle. So this is an economic model. But maybe even before we get into that, to try to maybe illustrate that the business cycle is kind of an organic thing that exists, it's important to think about this sort of trend here, right? And I think you can see this kind of pattern in a lot of different areas when we're thinking about knowledge. I think you could see this a lot in the sciences. If you have some sort of experiment, you might have certain bits of data that are a bit of an outlier, but there's clearly a relationship going on. I think you could see this a lot in the human sciences or even in everyday life. If you're sort of training for a sport or even throughout the semester of a class or something like that, you're going to have periods, if you're training for a sport, where you just feel like a machine. You feel awesome, you feel super strong, super fit, and then maybe the next week you don't feel as good. Okay, and then what follows from that is you're going to rebound and recover, and over months and over years of training, there's clearly a linear relationship of progress there. Okay, so it's quite similar. You might even see this sort of like with waves in physics and that sort of thing, right? So what this shows in the business cycle is that clearly we have a long-term trend. We can think about this dotted line in terms of an average, but then along that trend we have different points where we're either going to be above the trend, we're going to be above the average, or below the average, or in some cases right on it, okay? So this is going to be a different graph than maybe what we're used to dealing with, as in we're not going to have an X that has quantity to it, and we're not going to have a Y that has price, although there is some degree of price here. But the x-axis here is time. Okay, and one of our qualifiers here is that when we're thinking about time, we're not really trying to measure the long-term trend of an economy in even a year, or 2 years, or even 5 years is probably not enough. When we're thinking about the duration of the business cycle, it's best to consider it sort of across decades, sort of about 20 or 30 years of time is a reasonable sample size where you should be able to observe some degree of a business cycle going on, as in within that 20 or 30 years, it's very likely that you have multiple recessions and multiple boom periods, okay? So we're taking the long view here. We're not dealing with a few years, although you might be able to pick out a certain ranges of time where the business trend is very observable over a condensed period of time. But remember, we're dealing with a model here, okay? And then here we have real GDP. Okay, so it's important to unpack what that phrase real GDP actually means, okay? When we have GDP, or gross domestic product, that is the final value of all goods and services produced in one nation in 1 year. And when we measure GDP, we are trying to do it at the prices of the time. So when we try to measure the GDP of 2020, we would take the price levels of 2020 because that reflects what those goods and services that got produced in that year, what their value was. Now, since we're trying to compare things over 20 and 30 years of time, it's really important that we adjust for the price variations that happen over time. Now, in economics, we almost always have the idea of inflation. Things are going up in price on average, right? When we use that word inflation, we need to be careful that we don't misuse that term. Prices for individual things, whether it's real estate or commodities, right? Those things don't inflate. What we're thinking about in terms is like an average price level. Right, a rate of change for all of the goods and services in an economy. It's really difficult to measure, but it's important that we distinguish inflation from a price of just one thing going up, right? We're looking for a composite or an average here. Okay, so if 5 years ago, let's say 10 years ago. 10 years ago, since 10 years ago, we've had 15% growth in GDP. But since that, that might seem like, oh, we're doing really well. 15% growth during that time, that seems really great. If we don't account for inflation, it can make it seem like past years' growth were really excellent when maybe they were not, right? So if over that stretch of time we've had 15% increase in GDP, but prices have gone up 10%, that means during that time we've actually only had a 5% increase in GDP, while still pretty good for in terms of a long-term average. If we don't adjust for inflation, which is almost always going on, then in years past, things will look really good, right? So that's the relationship here. The business cycle basically shows over time, economies tend to have a long-term average growth rate, but we could have multiple years where we're above the average or we're below the average, and we need to think about why that was. Okay? So when we use real GDP, we're trying to adjust for the price level changes between years, and that's really important to coming up with a reliable figure when we're comparing growth across years. Okay? So let's talk about the stages that we have here. If we have any stage where the curve is upward sloping, so like this stage here, this whole stretch of time, however many years that is, we're going to say that is the expansion phase. I can't spell. Expansion phase. And what that basically means is there has been increases in national income every year during that phase. That may last 2 years, that may last 5 years, that may last 7 years. It's a bit variable, and it depends on the country, obviously, but an expansion just basically means that there's been an increase in national income over a certain period of time. Now, any stretch on this graph where we have a downward sloping line for our short-term fluctuation, we're going to call this stretch of time, fittingly, a contraction. Okay? So a contraction just simply means during a period of time there has been a decrease in overall economic activity, but the time frame is important here with at least the next word that we're going to use. Okay? One of the first stages that we need to think about in the business cycle is the idea of a recession. Okay? A recession is one of the most misused words in economics. Okay? A recession simply means that there has been a decrease in economic growth, a decrease in GDP for 2 business quarters or more. So business quarters are lumped into 3 months at a time. So in order for there to be a recession going on, that simply means that there needs to be 6 consecutive months of a decrease in GDP. Now, it's important to note there, people often use the word recession when the economy just isn't going how they would prefer it to go, but really the technical definition of a recession is when there's been 6 months or more, 2 business quarters or more of a decrease in GDP. Okay? So the very bottom of a recession, which we would identify as here, that we're going to say this is a trough. Okay? As in, this was the worst time before it got better. Okay? So a trough, the most recent trough that we've had would have been in 2009. In 2009, the United States was recovering from the global financial crisis. And in 2009, things started to get better. We saw that there was a bit of the word we're going to use next here, recovery, and economic growth started to return. It was greater than 0. It wasn't very good, but we were on a road to, getting people working again, getting wages going again. So that stage immediately following a recession is the idea of an economic recovery. Okay, an economic recovery. And the very last stage, usually recoveries go on for longer than a recession does. The typical time frame for a recession in the United States is about 9 to 12 or to 15 months, anywhere in there. Recessions typically tend to be pretty brief and pretty bad, but the recovery period that follows is usually longer than the recession. And then we do get to periods of economic boom, right? As in, we have a growth rate that is unsustainable. We have a short-term fluctuation that is greater than the long-term average. And that is a really good indicator that a recession is about to come up. So another place to label the boom here would be here. Okay? When we have multiple years of an economic growth rate that is higher than the long-term average of a country, that's a very strong predictor that a recession is coming. Okay? So there's a couple of reasons why that is, right? But this is, we're going to get into some qualifiers now. This is a model, okay? This is an aggregation of data. This is data points added up over time for multiple countries, and it typically looks something like this, okay? This is not a list of plotted points for one individual country, although for certain countries at certain times, you could pick out a real GDP and a time that looks very similar to this. So the United States, for the past 20 years, follows something pretty similar to this. We had recessions in 2001, and then 2008, and then 2009. But since then, and in between those periods, we've had recoveries and some periods of very high economic growth that we quite obviously cannot sustain. Okay, so this is an economic model. It's an aggregation of data. It doesn't always align exactly with reality, but it's pretty close most of the time. Okay, so this is an economic model, and it's probably more skewed toward developed economies. There's a couple reasons for that. Typically, developed economies have better institutions. They have better tax authorities. They have a more established central bank. They have a more effective government. And their business cycle is likely to be flatter. Okay? In developing economies, typically the economic growth rate is a lot more volatile. Or in certain countries, you might have a growth rate that's negative for a very long time before they experience a recovery. So this is also probably more indicative of a developed economy because, quite simply, developed economies are better at tracking and recording and making public their own data, whereas that doesn't always happen maybe as much as we need it to if we're thinking about nations that sort of meet the definition of what it means to be a developing economy. Okay? So we've covered the qualifiers here. This is not exact, right? It is a model. It's a bit of a simplification. If you were to look at the business cycle for developing economies, it might not look like this, whereas it's much more likely to look like this if you're looking from the standpoint of the United States or the United Kingdom or Japan or something like that. And then here we're taking the long view. We're thinking about decades at a time, not individual years. So in terms of why this model looks like this, probably why do we have these short-term fluctuations where we're above the long-term average and then below it? It probably mostly has to do with price levels. Okay? Boom periods are typically associated with really high prices. And that means high prices for just about everything. Real estate, commodities, the stock market. The prices for things are really inflated, and the cost of living is very high. That can't be sustained for the long term because that tends to eat away at people's income. They demand higher wages. It gets more expensive for businesses to produce, and then once businesses become less productive, the growth rate goes down. Okay? Expectations are a thing as well. Typically when we have boom periods, if you think about like the 1920s, people might not say it publicly, but they kind of know that the party can't last forever, and something bad's going to happen soon. So in boom periods, that's when you see people tend to not act very rationally, and they'll do things that will actively make a recession more likely. You usually see higher levels of debt during boom periods, and all of that, what I just said about inflation and debt, that sounds pretty similar to what we're dealing with right now in the United States here at the beginning of 2021. Number two, why do we have these fluctuations? That mostly deals with government policies. When we have a recession, usually the politicians in office find that politically undefendable, and they feel like they need to do something about it in order to get reelected. So President Obama in 2008, he passed the American Recovery and Reinvestment Act, which was this massive government spending bill. He cut taxes. The Federal Reserve dropped interest rates to essentially 0%. And all of those policies accelerated economic growth. We'll talk about that a little bit later on. And then we had a pretty long recovery period. And usually during boom periods, inflation gets really high, and that's specifically a problem for lower and middle income earners who just don't have that much space in their budget. So governments will typically do some things to try to curtail inflation and bring it down a little bit, and that usually leads to a decrease in economic growth because they're sort of taking money out of circulation. So another useful thing about this diagram is it helps us to distinguish between a decrease in economic growth, right? A decrease in economic growth is when we have a downsloping line. We have a recession, we have a contraction. That's a decrease in economic growth. We need to be able to distinguish between a decrease in economic growth and a decrease in the economic growth rate. So a decrease in the economic growth rate we can observe during a boom period when our curve starts to flatten out a little bit. Okay? If we have had multiple years of a short-term fluctuation that is greater than the long-term trend, and that short-term fluctuation starts slowing down, right? That's a pretty good sign that a recession or a contraction is on the way, right? So a decrease in economic growth means the curve goes down, like here. A decrease in the growth rate means we had a very sharp upslope, as in a lot of economic growth, but then it starts to flatten out. A decrease in the growth rate. That's an important distinction to be able to make. You can also observe that on the business cycle. Okay, so this is a pretty useful diagram. It is not a crystal ball. There are things called black swan events that nobody can really predict. Obviously, the 2020 version of that was the coronavirus pandemic that put us in danger of being in a recession. The business model can't predict that kind of thing, but the longer time horizon you have, the more predictive the business cycle becomes. So it's a very useful diagram if you're first learning macroeconomics. It's important to know how this diagram works and why it works the way it does. Okay? Thanks, guys.